Okay, so welcome to other students also, Iftikhar, Vinith, Kirti. Bala would be joining. I think I'll start off briefly. So now as we approach the ACCA examination financial reporting paper, so we already know the course structure and we already know the exam pattern, but just a quick recap. We have three sections, one covering objective type or objective test questions, where you will be given a single question and then you will be given a single question where you have to put out the figure out the answer. Then you have objective case question where you will be given a case scenario. Based on that you will have objective test question, and then you have a constructed response question, which is a long form question which will be 20 marks each, right? These are the three breakups, and just a quick overview of what are the areas tested in the recent examinations, right? So this is updated till the September-December 21 attempt. So almost in every attempt you would see one question coming up from the group financial statements, the consolidated financial statement, financial position, associate and disposals, right? So every attempt you see one or the other area from that part would be tested. Then single entity financial statement, when you have to prepare the again statement of P&L, statement of changes in equity, cash flow, that is there. Then the third part which is consistently tested is the performance appraisal, that is basically the interpretation of financial statement, the ratio analysis and related aspects. Almost every attempt you can see a question being tested. And coming to the standards, right? So here there is no no such thing like each standard is tested every attempt. In each different attempt you have different type different questions coming up from different standards, so we have to be thorough with all the standards that are covered, right? Surprisingly nothing has been tested yet for IFRS 16. We may expect some question. Now one important aspect or component is with respect to time management, and here is where I have seen a lot of students kind of struggling, because they are not able to complete the given set of questions in time, right? Now we have 3 hours and we have 100 marks to attempt, which works out to, as a rule of thumb, you all would have been doing it, 1.8 minutes per mark. But now I would like to slightly change the orientation here, and what I would want my students to do is, in the examination, whenever you have this objective type questions, right? Objective type questions can generally be done faster as compared to a constructive response question. So for objective type questions, try to finish up in about 1.5 minutes per mark. That is, because it's a 2 mark question, you will have about 3 minutes on an average. Okay, some questions may take longer, but try to finish up 3 minutes on an average each of these questions, so that you can save time in the constructive response question, because constructive response question would be lengthier questions, so you need to save time out there. For that, try to finish up the objective type questions faster, right? So that is one, a broad overview of the 3 different sections. 2 mark objective test questions, direct questions or calculation related questions will be simpler to handle, so you should try to cover this section A in about 45 minutes, section B in about 45 to 50 minutes, and the balance time we can give for the constructive response question. I will come back and I will tell you how to handle constructive response questions and all of that. The agenda for today's session is to revise key concepts, important chapters, difficult concepts which can be used or which you can use for your examination, right? So that is the whole idea of these revision sessions. Over a period of next about 7 to 8 sessions of 1 hour each, we will be broadly covering and quickly revising the important concepts of respective chapters. And in the meanwhile, if you have any specific ask that if you have any specific topic you want me to cover in more detail, please let me know. I'll take a minute's break, I'll get my iPad along, and then I'll start the session. If you have anything specific that sir, please cover this topic, like Bala had informed that he wants me to cover financial instruments, like that, if any one of you have any specific topic to be covered from examination point of view, please ping in the chat box and I'll be taking that in one of the revision sessions. Any more topics to be covered you think would be needed? Soumya, Bala and other students also who have joined in. Iftikhar, Vinith, Kirti. See, feel free, whatever is the level of your preparation.
Yeah, I think I feel it's better to cover the important chapter for the exams, because people like me,
Yes.
I was not able to complete all the recordings. I was not able to complete listening to the recordings. So that will be great if you cover important chapter. Keep in mind what we get in the exam. That will be really helpful.
Sure. So that I'll
And this is really helpful session. I feel like 7 days I think cover quickly as much as possible.
Yeah, I'll try to cover as much as possible. Of course, we cannot cover everything in 7 days. Otherwise, everybody would have just done 7-day session and we would have written the examination, right? So that cannot happen.
That's what I'm saying. At least people like me, they get at least a little bit of knowledge just to attend the exam. That's
Sure.
the main whole intention from my side.
Definitely. Bala, if you have anything else to add.
So sorry, sir. I just joined this.
Correct. Yeah. So the thing is, the question I was asking is, you mentioned financial reporting. That definitely, I would be taking a financial instrument. Sorry. Apart from that, if you have anything in mind, did you figure out some more topics to be covered? You can let me know, and then we can start off the sessions. Other students are also waiting. Other students can also ask. You can feel free to ask, even though you have not attended the regular classes.
Sir, I feel like leases, other than financial asset, leases and consolidation statements.
Yeah, consolidation is definitely in my mind, that we would be doing. Consolidation, business combination. So today we will start with, you might not have expected, but we'll start with non-current assets to begin with, because though it is an easier topic, but a lot of times students miss out on some specific aspects and they lose important marks. See, non-current assets is an easier topic where we can score more marks. So I'll make it faster. A quick revision or recap of non-current assets is what we would be doing first, and then gradually we'll move to the tougher standards. Okay. So now, as we have been discussing, so let us get on to the actual class. Enough of general discussion. So today we'll start with non-current assets. I know these are simpler standards, but still highly scoring. You can score, and there are very few concepts to remember here, right? So non-current assets, when we talk about, we cover IAS 16. This is to do with PPE. We will cover IAS 40. This is to do with investment property. Then we cover IAS 23. This is to do with borrowing cost. And then we cover IAS 20. That is to do with your government grants. Okay. We'll quickly, are you able to see my screen? I'm writing on the pad actually.
Yeah, we can see.
Yeah, okay. Thanks. Right. So these are the 4 standards that we would be covering. 4 standards we will be covering as a part of our first quick revision for ACCA FR paper. Now, when we say property, plant and equipment and investment property, these two have to be studied in tandem, or you have to relate both of these and we should read them. Now, when we talk about property, plant and equipment and investment property, the only difference between these two is that investment property covers land and buildings. It covers land and buildings which is kept or which is held for earning rental income or capital appreciation. So any land or building which we are holding for rental and capital appreciation, you will classify it under IAS 40 investment property. Then under PPE, what we get is, we get all tangible assets. We get all tangible assets which are used in business for production, supply of goods and for rendering of services, for earning rental income or for administrative purposes. So you might see that similarity: production and supply of goods and services for rental income and for administrative purposes. Here also I am saying rental income, here also I am saying rental income. The difference is, if it is land and building for rental income, then it is investment property. If it is land and building for for rental income, it is investment property. And if it is other asset like machinery, car and etc., those are given for rental purpose, that is also called as property, plant and equipment. And if you are using any asset for admin purposes, air conditioning equipment, office equipment, computers and all of that, those are also called as property, plant and equipment, right? So when we say property, plant and equipment, this covers your fixed asset. When we say investment property, land and building for earning rentals and capital appreciation purpose. Okay, that is what is the understanding of property, plant and equipment and investment property. Now, whenever we talk about property, plant and equipment and investment property, we need to figure out what is the initial recognition. To recognize an item of property, plant and equipment or investment property as an asset, it must meet the definition. There must be future economic benefits. It must meet the definition of asset. It must meet the recognition criteria, that is, it must be used for more than 12 months. It must provide us future economic benefits, and we must be able to measure the cost reliably, right? So if it meets this criteria of this definition of asset or PPE or investment property, it gives us future economic benefit. If we can measure the cost reliably, then we recognize, or we initially recognize, the item of property, plant and equipment or investment property. Now, initial recognition, I will call it IR, it is always at cost. Initially, you will always recognize an item of property, plant and equipment at cost only. And when I say cost, it is purchase price plus non-refundable taxes plus other cost, transport, insurance, any other cost to bring the asset to current condition and location. Okay, a broad description. If you are recognizing an item of property, plant and equipment, initially you will measure it at cost. To that cost, you will add any other directly attributable cost to bring the asset to current condition and location, plus the present value of decommissioning or dismantling expenses. So whatever is the dismantling expenses, you will calculate the present value. At that present value, you will say, okay, this is the present value of the dismantling expenses. That present value will also get added to the cost of the property, plant and equipment. Okay, now this is initial recognition. Initial means first time when you are accounting, you will account for it using the cost model only. This includes purchase price, any other directly attributable cost, taxes, transportation, insurance and cost to dismantle or cost to decommission at present value. You will not include admin expenses, abnormal losses, startup expenses, training. All these are not included. So what you will include is, till the time the asset is in a ready to use condition, whatever is the cost that is being incurred, that you will include in the initial cost. Then once you have initially recognized and initially measured, there comes subsequent measurement. Now when I say subsequent measurement, subsequently, so for example, 1st of April of a particular year we have initially recognized. 31st of March of year 2, how should we subsequently measure the item of property, plant and equipment? So, two things you have to keep in mind. One is depreciation. Second is model used. Model means whether you are using the cost model or whether you are using the revaluation model. So, that model you have to keep in mind, which model is being used, cost model or the revaluation model, right. So, depreciation is nothing but allocation of cost over its useful life. Generally, you will be tested on SLM basis. There could be a WDV basis also. How do we calculate depreciation under SLM basis? Take the cost minus residual value will give you depreciable amount. Depreciable amount divided by useful life will give you depreciation per year. Very simple calculation. Cost minus residual value will give you the depreciable amount. Depreciable amount divided by useful life will give you depreciation per year, right. And that depreciation every year you will charge. Under WDV method, what you will take is, you will take a cost, you will multiply a percentage of depreciation to arrive at the depreciation. Now, for WDV, I will give a quick example. Let us say cost is 10,000, depreciation is 20% on WDV basis. So, year 1, 20% of 10,000 will be 2,000. So, WDV will be 10,000 minus 2,000, 8,000. Year 2, 20% you will calculate on this 8,000. So, you will have 1600. So, this becomes 6,400. Like this, you will calculate depreciation using the WDV method. Now, when we talk about subsequent measurement, there are two models, which is cost model and revaluation model. When we say cost model, you take cost,
it's 13 hours,
minus depreciation minus impairment loss if any. This will give you the carrying amount. So, you take cost minus depreciation minus impairment, you get the carrying amount. Under revaluation model, what you do is, you value or revalue the asset at fair value. So, every year end or periodically 1 year, 2 year, 3 years, the company can decide that policy. You will revalue the asset at fair value. Now, what do I mean by revalue the asset at fair value? Say cost is 10,000, accumulated depreciation is 2,000, 10,000 minus 2,000, 8,000 is your carrying amount. Carrying amount is 8,000. Fair value is, let us say, 9,000. So, under the revaluation model, what you will do is, this 8,000 you will increase to 9,000 and say, now the assets are worth 9,000. Now the assets are worth 9,000. Under the cost model, you will say assets are worth 8,000. Under the revaluation model, you will say assets are now worth 9,000. So, basically what you are doing is, PPE value you are increasing by how much? 1,000. This is called revaluation surplus. This is called revaluation surplus. Now, multiple scenarios are possible under revaluation model. There can be upward revaluation, there can be downward revaluation. Downward meaning instead of 9,000 it can be 7,000 also. If it is an upward revaluation, for the first time, upward means where you have increased the value, so there is a gain. So, upward revaluation for the first time when you do, there is a gain. So when there is a gain in upward revaluation, what you will do is you will take it to OCI. You will recognize the revaluation surplus in OCI. So first time upward revaluation is taken to OCI, other comprehensive income. Okay. Then downward revaluation first time will be taken to P&L. Always remember, first time upward revaluation will go to OCI, first time downward revaluation will go to P&L. Then if it is subsequent upward revaluation, then if there was an earlier downward revaluation, then you will credit P&L and balance part will go to OCI. If earlier it was upward revaluation, then you will take entire amount to OCI. Okay. So I am again I am again revising this part for you. If first time it is upward revaluation, you will take it to OCI. First time downward revaluation, you will take it to P&L. That is a very simple thing. Subsequent upward revaluation, you have to check whether earlier there was downward or upward. If earlier it was downward means what? We have taken something to P&L. To the extent of this amount available in P&L, you will credit the P&L, balance you will take it to other comprehensive income. Similarly, if earlier it was upward revaluation, means earlier we had not taken anything to P&L, debited anything to P&L, entire amount will be credited to OCI. Now downward revaluation, if I am doing subsequently I am doing a downward revaluation, here also you have to check what was done earlier. Okay, if earlier it was upward, then first you will debit OCI, balance will go to P&L. If earlier it was downward, then you will debit P&L. So in a nutshell, if earlier amount debited to P&L, you can credit P&L. If earlier amount credited to OCI, then you can debit OCI. This is the most complicated part when it comes to the revaluation model. So revaluation upward, downward, upward is OCI, downward is P&L. Revaluation subsequently, if you are reducing it, subsequently if you are doing a downward revaluation, then if earlier it was an upward revaluation, the balance first you use from OCI, then any leftover balance will go to P&L. Any question in this revaluation model specifically? Any question? You can type in the chat box if you have any doubt, and if it is clear, you can just say all clear, I can continue. Subsequent. So when I am saying subsequent here, when I am saying first time here, we are doing it for the first time. When I am doing subsequent means earlier there was some revaluation already done. So let us say year 1, carrying amount is 10,000. Carrying amount is 10,000. Fair value is 12,000. Now there is a gain of 2,000. So what you will do is you will debit PPE and credit OCI by 2,000, 2,000. This is the first time revaluation. Now let us say for the same asset, okay, for the same asset in year 2, once we have increased it by 2,000, now we will carry the asset at 12,000 and there would be subsequent depreciation also. So what happens is now this 12,000 will be depreciated over remaining useful life. So in year 2, assume for a moment carrying amount after depreciation. So you have 12,000 and assume for a moment 2,000 is depreciation. So or 2,000 maybe sometimes 3,000 is the depreciation. So 12,000 is there, remaining useful life is 4 years. So 3,000 is depreciation, carrying amount is 9,000 and fair value is 8,000. Now there is a loss of 1,000. Okay. Now this loss of 1,000, if it was for the first time revaluation, then we would have directly taken in P&L. But now I have got a loss of 1,000. I have already recognized a gain of 2,000 earlier. So what we need to do is this loss we should offset against the OCI. So what I will do is I will debit OCI and I will credit PPE by 1,000. Okay. I will debit by OCI by 1,000, credit PPE by 1,000. If for example carrying amount was 9,000, fair value was 5,000, loss is 4,000. So in that case what I will do is I will debit OCI by 2,000. Sir, why 2,000? Because earlier we have credited OCI by 2,000. So whatever is the balance available in OCI, I will use that balance to recognize the loss. Remaining amount I will debit to P&L. Out of 4,000, OCI is 2,000, P&L is 2,000 and credit to PPE by 4,000. Is it clear?
Yes.
Soumya, is it clear?
So year 2 carrying amount to capital, sir, 9,000.
Year 2 after the revaluation carrying amount will be 5,000 or 8,000, whichever is the scenario as the case may be. Okay. And this carrying amount will be depreciated over the remaining useful life. Okay. Now, this is broadly about IAS 16, try to cover in about 20 minutes time. Now, about IAS 40. IAS 40 is pretty much linked to IAS 16. Initial recognition at cost only. So, initial recognition you will take it at cost. Subsequent measurement, you can use cost model or fair value model. Cost model is same as IAS 16, there is no change. So whatever you have learned in IAS 16, same thing can be used. Fair value is not the same as revaluation model. Fair value is a different model. Now what is the fair value model? Under the fair value model, you will calculate fair value at year end. Compare fair value with carrying amount. Gain or loss will be recognized in P&L, and very importantly, no depreciation. Sir, why no depreciation? Because anyways we are valuing it at fair value. Depreciation will also be recognized in P&L. Fair value gain or loss is also recognized in P&L. So there is no depreciation to be considered. Whereas under revaluation model, revaluation gain is taken to OCI, depreciation is taken to P&L. So you will have revaluation separately, depreciation separately. Under fair value model for IAS 40, there is no depreciation to be calculated. Okay. So that is about investment property quickly in a nutshell. Then there can be transfers like something is earlier under IAS 16, something is under IAS 16, it can move to IAS 40. Office building is there, we have been using it as office, now we don't want to use it at office, now we want to give it out on rent. So IAS 16 to IAS 40 is there. If that is the case, then you will revalue under IAS 16 and then transfer to IAS 40. Okay. So after that it becomes an your investment property under IAS 40 if you are following IAS 40 में fair value model, right? Then if it is investment property under IAS 40, that now you want to move it to IAS 16, you will consider fair value on date of change. Similarly, if you want to move something from IAS 40 to IAS 2 inventory, again you will consider fair value on date of change. Okay. So that is how you would reclassify the investment from investment property to property, plant and equipment, or from property, plant and equipment to investment property.
Sir,
Yes.
here if cost model is used, we can just directly
Cost to cost.
transfer
Yeah.
to
Directly cost to cost. Okay. Now, the linked component to both of these is IAS 23, which talks about borrowing cost. Now, as a part of your cost of property, plant and equipment or cost of investment property, if there is borrowing cost incurred, one thing, I am going fast because this is a revision thing. Okay, I will not get into logics of why and how things are done, because for logics and all there is a detailed lecture available, you can always go back and refer to it. Okay. So if there is borrowing cost incurred, borrowing cost is like your interest cost. If it is incurred on a qualifying asset, what is a qualifying asset? Which takes substantial period of time to get completed for use or sale. So you are incurring borrowing cost, interest cost on a qualifying asset which is being constructed or which is getting ready for use or sale. And when we say qualifying asset, normally which takes 12 months or more. For example, construction of building, construction of bridges. If you look at inventory, let's say wine business and all of that, where it takes substantial period of time, which is 12 months or more to be completed, then borrowing cost which is attributable to the qualifying asset should be added to the cost of the asset. Now, you have to understand commencement of capitalization and cessation or stopping of capitalization. Now, when I say commencement and cessation of capitalization, I mean when should we capitalize borrowing cost and when should we stop capitalizing borrowing cost. We should start capitalizing borrowing cost when you are incurring expenses, you are incurring borrowing cost and activities are going on. So, construction is going on. When construction is going on, you are incurring expenses on that construction and you are incurring borrowing cost for the amount borrowed. So, if these three, all three should be there. Sir, I am not incurring expenses, you cannot capitalize borrowing cost. Sir, we are incurring borrowing cost, but the activities are not going on, the activities have stopped. Okay, we have borrowed money, but labor has, labor strike is going on, or raw material shortage is there, or COVID happened. For whatever reasons, the work is not happening, then you cannot capitalize. All these three conditions must be ticked. Borrowing cost must be incurred, expenses must be, being incurred, and activities must be going on. Then you can commence the capitalization. When I say capitalization, adding the borrowing cost to the cost of the asset, and cessation of capitalization. You stop capitalization when the asset is ready or substantially ready. The entire building is ready, just inauguration is pending, but the building is ready. Once the building is ready, the substantial activities are completed, then you will stop the capitalization of borrowing cost. Now, as far as borrowing costs are concerned, at your level, two things you have to keep in mind. There can be specific borrowing and there can be general borrowing. If there are specific borrowing, then you will take the borrowing cost for the period less income on temporary investment. Borrowing cost minus income on temporary investment is the capitalization amount. If it is a general borrowing, you calculate something called as weighted average rate. You calculate weighted average rate, and using the weighted average rate, you calculate the borrowing cost to be capitalized. How to calculate weighted average rate? Say for example, borrowing 10 million, rate is 5%, borrowing 5 million, rate is 6%. So what you do is 10 into 5%, or I will make it 100, no? Easy to calculate. 100 into 5%, 5. 50 into 6%, 3. So total interest is 8, total borrowing is 150. So weighted average rate is, or this is also called as the capitalization rate. Capitalization rate is 8 divided by 150. So which will be 8 divided by 150. If I do, I get 5.33%. So 5.33% is the weighted average rate to be used for capitalization. Only so much is what you need to remember and understand as far as the borrowing cost is concerned. Okay. Then moving to the next part, which is IAS 20. This deals with government grants. Right. Now, government grants means government is transferring some resources based on some conditions being satisfied. So you should recognize government grants when conditions are satisfied and grant is receivable. Okay. Or the conditions will be satisfied by the company and grant is receivable, or the company is sure that the grant would be received, right. So if these two conditions are satisfied, you should recognize the grant. Now there are grant related to assets, there are grant related to other than assets. There are grant related to assets, or there are grant related to other than assets. If it is a grant related to asset, you can either reduce the grant from cost of asset, or you can follow a deferred grant approach. If it is for other than asset, you will set up something called as a deferred grant account. Now, what is the meaning of deferred grant account? See, reducing from the cost of asset is very simple and straightforward. I bought an asset for 100, government gave me 40 of grant, 100 minus 40, 60 should be the value of the asset. But what is this deferred grant approach? For deferred grant approach, what we do is when we receive the grant, or when the grant becomes receivable, we debit bank, we credit deferred grant. The government says, you employ 100 people for 3 years, you employ 100 people for 3 years, we will give you 300 of government grant. So you will debit grant bank 300, deferred grant 300. Now condition has to be met over 3 years period. So every year we will debit deferred grant 100, credit income 100. Every year you will transfer an amount systematically from the deferred grant account to the income account. So, debit deferred grant, credit income 100, 100 each year you will transfer. Same way, if it is deferred grant approach followed for an asset, you will credit the grant to our deferred grant account, and in the ratio of depreciation you will transfer to income in the ratio of depreciation. So, in the proportion of depreciation from deferred grant account, you will transfer it to the income statement. Please remember, this deferred grant account is a liability account. You will show it as a liability in the balance sheet. If you are reducing it from the cost of asset, you will reduce the grant from cost of asset, and on the balance amount you will charge depreciation. Clear? So, this is a summary or quick overview or discussion of the chapter non-current asset covering IAS 16, IAS 40 and IAS 16, 40, 23 and 20. Now, what you can do is, I have already shared the exam kit in the book or in the WhatsApp group what we have. You can use the exam kit and you can practice some MCQs today, whatever time you have. If you have any doubt in any of the MCQs, or if you want me to solve any specific MCQs from this particular topic, that is non-current asset, please ping me. I will take it up in tomorrow's revision.
Sir?
Yes?
Sir, while doing this specific borrowing concept, I have a doubt, sir.
You are doing what?
Borrowing cost, sir.
Okay.
So in specific borrowing, we used to calculate whatever they have borrowed, the interest on that will be capitalized, the particular borrowing.
Correct.
But what if they have borrowed like 50 million they have borrowed, but they have used only 40 million for the asset?
So, you will use only 40 million.
40 million on the interest rate.
So, what you, what you have to keep in mind is, it has to be linked to these expenses also.
Yes, sir.
Okay. So, if I have borrowed 50 million and I have already spent 50 million, then you can capitalize. If I borrowed 50 million and 10 million I have not used, that component cannot be capitalized.
Yes, sir.
Okay.
And in general borrowing it is clear, sir.
General borrowing, whatever you have spent, you have you have to capitalize that. So, normally I will tell you one thing. Okay. So, what happens is, in specific borrowing also, they would not give you a scenario where they would say we have borrowed higher and then amount spent is lower. Okay. Now, if you go with the, and I don't want to confuse you, at a higher level you will understand what the standard says is amount of borrowing cost incurred less income on temporary investment. That is what the bare standard says, right? So, depending on how much amount has been spent, and see, because what we do is normally borrowing cost and interest on temporary investment we reduce. So, you can take the total borrowing cost and reduce the income on temporary investment, that will give you the net capitalization amount. So, for example, just to add on to that, we have borrowed 400, we are using 300 and 100 we have invested. So, what you will do is, on 400 you will calculate the borrowing amount or borrowing cost and reduce this income, and the net amount will be capitalized.
Yes.
So, normally such kind of questions will have that yes, we have taken the borrowing total and some part is invested outside if you have not used. So, that investment income when you are reducing, so you will take the total borrowing cost minus this investment income.
Yes, thanks.
Okay. Yeah. Chalo, thanks a lot. We will continue tomorrow. So, I am trying to compress about maybe 5-6 hours of lecture in 1 hour time, so that it gives you a quick revision part.
Yeah, thank you, sir. That's what I wanted. Thank you so much. This is the recap I wanted. As you said, I just go and do the kit now.
Kit link I have shared in the group, and you can do it.
Yeah.
Sure.
Okay. Thank you so much, sir.
Thank you. Yeah.
Same time tomorrow, right?
Yeah, same time.
Okay. Thank you.
Thank you.